Let's dive straight into the massive corporate restructuring of Vedanta and find out exactly what is happening to your money. Welcome to this explainer. Today, we're taking an incredibly complex, shifting financial event and breaking it down so you can see exactly what's going on behind the scenes.
So, if you recently logged into your broker app and had a minor heart attack seeing your stock price crash by 60%, literally dropping from near 795 rupees all the way down to that 290 to 320 rupee range, okay, take a deep breath. Seriously, don't panic. You are actually just witnessing one of the single largest corporate restructurings in Indian stock market history.
To explain exactly where your money went and when it's coming back, we're going to unpack this 1 to 5 demerger step by step. We'll hit the initial shock, the corporate blueprint, the math behind the pricing, the timeline map, and finally, the verdict on the real risks and rewards. All right, let's start with Section 1, the shock, and clear the air immediately about that terrifying drop you saw in your portfolio. The absolute truth here, you didn't lose a single rupee. I know it looks like a devastating crash, but it's actually just a 1 to 5 demerger. Vedanta is essentially breaking apart its massive, tangled conglomerate structure. Your total value is fully intact. It's just, taking a different form on the market. So how is this new structure actually going to look? Let's move to Section 2, the blueprint, and explore the why behind this massive shift. Why did the board decide to break the company apart in the first place? Well, it fundamentally comes down to solving something called the conglomerate discount. For years, Vedanta was this giant everything bucket of aluminum, oil, power, and steel. And honestly, institutional investors kind of hated this because they couldn't choose specific exposures. Think about it. A fund manager might absolutely love Vedanta's aluminum business, but totally despise the debt in its power business. Because the whole thing was tied together, the market historically valued the entire holding company way less than the sum of its individual parts. To fix this huge discount, Vedanta is splitting into 5 distinct pure-play listed companies. Let's look at the new lineup. First up is the residual Vedanta Limited. This remains the listed parent entity, and it houses base metals plus that highly profitable 64.9% stake in Hindustan Zinc. Next, we've got Vedanta Aluminum Metal Limited, managing those massive smelters. Third is Vedanta Oil and Gas Limited, holding the exploration blocks. Then there's Vedanta Power Limited, managing the merchant power assets. And rounding out the whole shebang, we have Vedanta Iron and Steel Limited.
Now, the blueprint for how you actually get paid out is super clean. It's a 1-to-1 ratio. This simply means for every 1 original share of Vedanta you held, you keep that parent share, and you're going to receive 1 additional share in each of the 4 newly created companies. So, let's say you originally held 100 shares. You will end up with 100 shares of each of the 5 companies, giving you a grand total of 500 shares.
Okay, so if you're getting all these extra shares, why on earth did the price drop so dramatically on your app? Let's jump into Section 3, the math, and uncover that invisible value.
Think of the original company like an 800 rupee box of assorted sweets. Once you remove the premium pieces during the April 30th XD merger date, the residual parent price naturally adjusts to roughly half its original value. The market basically stripped out the value of the aluminum, power, oil, and steel arms, leaving the parent stock to settle at its standalone fair value. That remaining phantom value is then split across the 4 new entities. Roughly 52.3% stays with the residual parent, 21.5% shifts to oil and gas, 12.2% to power, and the rest is divided between aluminum and iron and steel. The value is there, it's just temporarily invisible on your broker app until those new shares officially list.
To understand exactly when you'll see this phantom value actually materialize, we need to move right into Section 4, the map, and chart out the crucial dates and tax rules.
Because India operates on a strict T+1 settlement cycle, timing is literally everything here. April 29th, 2026 was the very last day to buy shares to be eligible. The XD merger date landed on April 30th, followed closely by the record date on May 1st. So the really crucial takeaway here is this. If you bought on or after April 30th, you bought XD merger. That means you only get the residual parent stock with absolutely zero eligibility for those new companies.
Now, if you did qualify by holding the stock before the cutoff, you just need a little bit of patience. The credit window typically takes about 45 to 60 days from the record date. NSDL or CDSL will send you an automated email when the shares actually hit your account. Now, this is all going to happen ahead of the targeted listing window on the NSE and BSE, which we're expecting between June and July of 2026.
Okay, pay very close attention to this part, because taxation rules around demergers can get incredibly tricky. But the good news, and you can breathe a massive sigh of relief here, is that receiving these shares is completely tax neutral today. Yes, you heard that right. You do not owe a single rupee in income tax or capital gains tax right now just for receiving these newly spun off shares.
However, your tax structure for the future does change a bit. First, your original cost of acquisition splits across all 5 companies based on an official mathematical ratio that'll be published. But crucially, the income tax department allows a major benefit here. The holding period clock does not reset. Your original parent buy date transfers perfectly to all the new shares, and that leads right into the final point. If you hold for over a year from your original purchase date, you automatically qualify for long-term capital gains benefits on all 5 entities the absolute second they list.
Let's bring this all together. We've seen the mechanics, but what's the ultimate takeaway? Let's hit our final section, Section 5, the verdict, to weigh the big picture.
The absolute crucial point here is balancing the massive potential upside against the very real risks. The upside is pretty clear, right? Value unlocking. Pure-play companies can see a major valuation re-rating compared to standalone peers, they can raise capital independently, and they attract highly targeted institutional money. But weighing against all of that is the debt elephant. Vedanta has historically carried a multi-billion-dollar debt load. How that massive historical debt gets carved up and allocated among these new, cyclically sensitive businesses is vital. If a capital-heavy business gets saddled with an unfair proportion of that debt, its individual standalone valuation could severely suffer post-listing.
Which brings us to the ultimate question. As you wait for the summer listings to bring complete flexibility to your portfolio, we want to know what your strategy is going to be when the dust settles. Are you going to hold all 5 pure-play companies, or will you cash out of specific sectors the exact day they list? It's a fascinating strategic choice, and understanding the layout we've covered today puts you firmly in the driver's seat. Thank you